think Lee Jasper told me once, most software companies either get acquired or go out of business. And ultimately, I think if you're operating in an ecosystem where you've got very large players, if you start doing really well, you're going to be noticed. They're either going to copy you or buy you.
Geoff, what's it like when you receive the offer and sign? Is it like is it fulfilling? Is it like a little bit like, is that like a tense period of time where you're just like, oh my God, it could still not happen,
I mean,
blah, blah,
there
blah.
always is a bit of bittersweet. I mean, while it's a great outcome and a great success story, at the same time, you've put your blood, sweat and tears. It's sort of a bit like your family. So,
Yeah.
there are some mixed emotions.
Hey everyone, and welcome to the Bricks and Bytes podcast, where we dive into construction and AEC technology. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology, and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
Okay, good. So, Geoff Tarrant, thank you very much for joining us. I guess I will just dive straight in here. And I cannot verify this claim myself, but according to an article I found when doing some research on this article, Payapps was acquired. Well, obviously it was acquired by Autodesk. That's not common news, but I don't think the amount was public knowledge till perhaps recently, which says around $600 million. Are you able to say yes or no to that?
That is pretty close to the mark. So, yeah, I think give or take a small amount, that's, pretty close to the round number. So, firstly, thank you for having me on, Owen and Martin. Pleasure to be here.
Yeah, thank you. Thank you for joining us. Okay, so shall we? Let's dive in then. We'd like to cut to the chase. So what was so great about the product that Autodesk felt that they had to buy such a solution?
Well, I think in terms of just explaining what Payapps does, I mean, we're in construction software, a fairly niche part of construction software. You've got sort of bigger players focusing on sort of project management and financial ERPs, whereas we were, very focused on one process, which was the claim process between builders and subcontractors. So once a contract's been let, typically in most jurisdictions, subcontractors claim monthly based on how much work they've done. And there's an assessment process and variations, and it does get more complex than it sounds. But at a basic level, we're managing the monthly claim process by subcontractors that have been engaged on construction projects. And in some geographies like the US, we're also managing the payment process as well.
Mm-hmm.
How was it done before Payapps?
Excel.
Look, before Payapps, it was, and there's still a lot of construction companies doing this, Martin. It's typically claims would have been submitted by email with Excel attachments, providing sort of some evidence and documentation. So it was a very cumbersome process because when claims are assessed, there's usually quite a lot of back and forth between the two parties. So when it's being done by email and you've got Excel spreadsheets going back and forwards, and there's a lot of other document like insurance and a range of things from a compliance point of view that often need to be in place. So it can be a very time-consuming and frustrating process. I think a lot of the times that contributed to it being more frustrating than it needed to be. No fault on anyone. Often the builder didn't get all the information they wanted from the subcontractor, and therefore the back and forth did create quite a lot of friction. So this was sort of a cloud-based version that allowed sort of collaboration between the builder and the subcontractor, so everyone could see what was going on. Nothing got lost. Sometimes we see errors as basic as not carrying forward the right amount for the month before on spreadsheets. So I think some of the bigger construction companies, it got more sophisticated in that there were like manually programmed sort of Excel spreadsheets and the like. But still, there's a lot of other things in terms of sort of having all of the compliance. I mean, you can set up, multiple levels of approvals. People can't submit claims till they have everything in place. So it really does make it a much more efficient process than existed before.
Before we go to the product, I would like to just touch on why perhaps, Geoff, what made it so great, and that ultimately that led to Autodesk wanting to acquire Payapps.
Yeah, I mean, I think what made it so great, I mean, I think it was easy and intuitive to use. I think the sort of, I mean, the genesis or idea with Payapps, co-founder Lincoln Easter, I can't claim any credit for the idea, Owen or Martin. Lincoln was, he worked for a mid-sized construction company where he was the CFO. So I remember he said he wanted to catch up for a drink and said that the claim process was the bane of his existence every month and there had to be a better way to do it. And he wanted to fix it and build a product. So, I mean, that was sort of where it started. I think in answering, I mean, why were Autodesk interested? It is quite a complex area. It's it takes many, many years to build out the product with a sole focus on that. And there's also, I would say, unlike some of the other areas of construction software, probably a much greater level of jurisdictional variance that needed to be reflected in the product. So there was no one else doing what we did that had significant market positions in multiple markets.
Also, sorry, Martin, I just wanted to touch perhaps holistically as well. And I saved this question for later, but I just want to ask now, perhaps, Geoff, you have some insight into this. But around about the same time, now my memory is going to kill me because Trimble bought a similar product. Was it called Flash Track?
Oh,
Maybe?
Flash Track.
Yeah. Which we actually covered on a previous episode of Bricks and Bytes. But I'm curious because Trimble bought Flash Track, Autodesk Payapps, and then Procore are now Procore are looking into the space, and there's been like some interesting PR around people stealing trade secrets between Oracle and selling and so on and so forth.
Yeah.
So why do you think that all of these like larger incumbent software providers are or were / are interested in this space so deeply?
Well, I think it's just, it's sort of an extension, I think, sort of sits between project management and the financial ERPs, but it's really important in understanding, how the project's progressing. I think when you do it all manually, it all sits in the top drawer of the project manager, and most projects are on budget till the last 10%. I think beyond just the efficiencies in the claim process each month, which are significant, you've got a lot more visibility as a company as to how your projects are progressing. Like one of the big areas is, well, what level of variations or change orders in the US are sort of building up on projects, which can provide sort of some insight into how profitable or not a project's ultimately going to be. So it takes years and years of work to build up the product. So it's not easy. And I think that's ultimately why we've seen there are sort of no meaningful independent players left in the space. I mean, Oracle bought the first texture many, many years ago, which was the sort of market standard in the US, but it probably struggled a little bit to move that product outside of the US to other markets. Procore bought Level Set, which was part of their ultimate sort of offering in the payment space. Sort of Autodesk has bought Payapps, and Trimble's bought by far the smallest of them, Flash Track, but ultimately there's no one left really. So I
Opportunity.
think it's sort of it's not an easy area, but it's an important area of the construction sort of process. And if you're going to have an end-to-end solution in construction software, which they're probably the four bigger players, it became more and more difficult to compete if you didn't have a product in that area.
So trying to understand this market slightly better, so it seems like every incumbent is acquiring or building their own payment solution. Why is that? You explained a little bit of this, but why is there a chance that there will be independent payment application that everyone can use it, everyone could grasp the market share, or why is it not the case? Maybe.
Look, I think there's no reason that other independents couldn't. Can't emerge. I probably think it becomes harder and harder. Like a lot of the customer acquisition to date had really been moving people from manual processes to sort of cloud-based processes. So there's still further to go on that journey, but clearly the digitization of that space has moved a long way in the last 10 years, and particularly the last probably 3 years. I think there's still plenty of opportunity there, but it will certainly get harder for new independent players emerging because there's a smaller sort of what we would call sort of white space opportunity. But yeah, I also think, ideally, I think most construction companies are wanting to acquire a solution that can do project management, claims, less focused on just the financial ERP, but actually to sort of, provide sort of, I guess, end to end from the start of the pre-construction phase all the way to the end of construction, which really, we're sort of at the back end managing the payment claim process, but it's still an important part of the overall project and the increased sort of putting everything together, the increased visibility, better compliance. I think it is really a core part of all of those four parties offerings now, which will make it slightly more difficult because when we started, other than Oracle, who bought Texture, I think back in 2016, you didn't have the larger incumbents with an offering in that space. Now they've all moved quite quickly to consolidate the space. As I said, there's really no one left. I think there's still a position for independence in the space, but it does take a huge investment and time to build that out, particularly beyond a single jurisdiction.
Mm-hmm. So I'm just curious, was Payapps built to be sold, or at some point there was thinking in the business that, okay, we just need to get to these points and then get acquired? Was it the thinking?
Look, I don't think we didn't really set out with a view that, look, X number of years we want to be acquired. I think even back when we started, we were acutely aware there were already larger players in the space, and I think it's not just unique to construction software, but I think Lee Jasper told me once most software companies either get acquired or go out of business, and ultimately, I think if you're operating in an ecosystem where you've got very large players, if you start doing really well, you're going to be noticed. They're either going to copy you or buy you. So you got to have a more difficult operating environment as the years go by. I think we didn't put a timetable on it, Martin, but I think we always saw there was going to be a natural point at some position that we were going to be acquired by one of the bigger players. And certainly over the journey, I can say at least the majority of those names you'd mentioned, we'd had approaches or discussions.
It feels to me that like a clear or a very common, I don't want to say the only way, but judging by successful outcomes within startups within the construction tech scene, it is generally through acquisition versus, let's just take an IPO for example. There's not a huge amount in the space. So
maybe you have some thoughts on this actually. Why?
yeah, I was going to say, Geoff, what would be your viewpoint on that? And also, we do hear concerns actually speaking with customers of software providers that they're concerned that they will that the solution that they embed into their enterprise will be acquired, and therefore they'll lose control, or the process will change, or something will put a hurdle in their way. So yeah, statement, but curious, Geoff, if you've had any thoughts about that.
Well, I think, I do have some thoughts on why they're being acquired rather than IPOing. I don't think I'm not sure in the last 10 years we've seen an IPO from a construction software company. So certainly not in the US that I'm aware of. So I think it is a function that you've got some very large players who not only are well capitalized, I think construction has been probably quite late to the technology adoption, so it's probably been a laggard. So the growth and opportunity that these bigger players have seen them have good growth metrics, trade on very strong valuations. So I think in order to grow a standalone sort of startup to scale up, you've got to take on external money. And I think once you sort of start taking on external money, you've got sort of fiduciary obligations when you start thinking about, well, what is the exit strategy? I mean, we did talk about and think about IPO from time to time, probably in the earlier days. I think as sort of growth capital really sort of expanded over the last 4 or 5 years, there became no real need from a capital perspective to go and do an IPO. I think the harsh truth is you've got big players on fairly attractive multiples that can pay a price for the business that is probably far greater than what an IPO would be. Certainly at the time you IPO'd, you could take a view that I'm going to do an IPO because over time I'm going to increase the value of my business. But when you've got larger external investors, look, if you don't always have the luxury of making that choice. I think once you're looking at a significant liquidity event, if much greater value is being offered elsewhere. And I think when I talk about elsewhere, I think like you've got strategic acquirers, but you've also got quite a lot of interest from the VCs and growth equity funds, and I think they're also paying higher multiples than what you could get from an IPO. So why would you want the extra burden and scrutiny of going and doing an IPO when you're not going to get any benefit in terms of valuation? You're going to have a lot more regulation, distraction, reporting obligations. So I think they're going to sit in growth equity funds until they get to a point where they get acquired by a strategic. It's hard for me to see that we're going to go back to a scenario that we might have. It was more realistic 10 years ago to see that. I think private capital markets have developed to an extent that is the default option. And yes, we do see a lot of acquiring in this space, but you've got the big four that you mentioned, but also other people trying to grow broader construction software companies. And I think if you do really well as a standalone point solution, you're going to have strategic interest.
Mm-hmm. Geoff, you mentioned that Payapps was with talks with other potential acquirers. Do you have any anecdotes from this time or what these conversations were like, or any lessons that you learned when juggling between potential acquirers?
Yeah, like I think one of the key I mean, my background before Payapps was in investment banking. So, I mean, I had a strong capital markets and M&A background. So I think an important thing for a founder to look at is, whatever market segment you're in, look, whether they might even be competitors of you, but I think it's important to build relationships and engage. So, ultimately, a lot of acquisitions do come out, or the higher value and better ones do come out of having built relationships, because I think it's always a lot harder if you haven't had that engagement and you pop up and I'm running a process and I'm selling a business. I do think a lot of the bigger players, they want to have a good understanding of the business. They want to know the people who run it. So, and it's look, there's a lot of interconnectivity between the ecosystem. Some of the potential acquirers are partners or people you integrate within the ecosystem. I would just encourage people that are sort of thinking that might be on the horizon in the coming years is don't wait until you decide to run a process. I think by then it's too late. You've got to build the relationships over generally, I think, to get the best outcome over a period of time leading up to that. I think the better they know the business and more comfortable they are with you, the better result that can be achieved.
Mm-hmm. Okay.
I think that a common thing people say that have been acquired in the past is they're building relationships with potential acquirers. It's not from day one, but like relatively early on in the process. Not because the intention is to get acquired, but that possibility is quite high, as specifically within the industry as well. So
and look, with Autodesk, we had discussions with them. I mean, back as in 2021, we built a partnership with them. We engaged with them quite regularly. So, I mean, all of that helped when it came time to time to the sale process. We didn't actually run a sale process. We were considering additional investment at the time, but that sort of precipitated ultimately the timing of the acquisition. But we'd built a strong relationship with them up until that point, and we really liked them. We knew them; they knew us. So it just made the process a lot easier.
What's the life like after acquisition? Is it sunbathing and surfing, or quite different?
Look, I stayed on for a bit more than 12 months after the acquisition. I'd say Autodesk it helps when the acquisition sort of performs well. So Autodesk were happy with the performance. They've been really good to work with. I think people do have some concerns, particularly with larger companies. I think they engage really well. I think there's really sort of strong on the employee well-being side of things. We had a really good, not very few people have left in the sort of 12 months sort of post-acquisition. So I think it was a really good fit from a product point of view, but it was also a good fit from a cultural point of view, which was, I think, one of the big considerations as well.
Mm-hmm. I'm curious, how big was Payapps when it got acquired, and what was the judgment as to, okay, this is the right time, or should we wait slightly more? Like, what was the thinking at that time?
Man, are you speaking like revenue figures?
Revenue
Size?
figures,
If you
yeah.
can share that, Jeff, or maybe
Yeah.
not, I don't know.
Look,
or maybe some other metrics, whatever you can share.
Yeah, look, not really in terms of revenue. I think in the, we were in the tens of millions I mean, not at the lower end, not right at the higher end. So, I mean, that gives you some idea sort of around where we were in the middle of that range. So, I think the considerations, it was, I mean, judging by how well the business performed in the 12 months post-acquisition, we certainly could have waited another 12 months. But, I mean, it wasn't, it was probably a consideration of a number of factors. It was sort of, around the timing of some of the other things that we were looking at doing in the business, and that would have required additional funding, which sort of probably would have reset things for another 3 or 4 years. So, I mean, in some ways, it probably was a bit earlier than we expected, but it wasn't. I mean, to answer your question, we hadn't sat there and said, look, late 23, early 24 is when we're going to run the sale process. That wasn't it. It's sort of, as I said, we didn't actually run a sale process. There were something that we were looking at and considering and having some discussions around funding. That sort of led to discussions with Autodesk, and things sort of went from there. So it was probably more, well, yeah, we had an approach and offer. It was sort of very attractive. We could have waited, but given we saw it as a highly attractive offer, we had a major institutional investor that had 35%. I think at that value, it was pretty, I mean, and I would agree it was compelling for them at that level. So there are a few reasons. It wasn't that we'd sort of planned out to the day that this was our time to sell. In fact, it probably came a bit earlier than we'd probably been thinking, that maybe it was going to be 12 months later. But a few different things happened that meant that the discussion happened a little bit earlier. And then having received the offer, it was something that that myself and the board thought was compelling. So we sort of progressed it at that time.
Geoff, what's it like when you received the offer and signed? Is it like, is it fulfilling? Is it like a little bit like, I'm not, you're like a little bit unsure at the time after do you have like some form of regret maybe? And then it's the period after between like actually signing the piece of paper to receiving whatever it is, the funds, etc. Is that like a tense period of time where you're just like, oh my God, it could still not happen?
I mean,
blah,
there
blah, blah.
always is a bit of bittersweet. I mean, while it's a great outcome and a great success story, at the same time, you've put your blood, sweat, and tears. It's sort of a bit like your family. So, there are some mixed emotions. It still is a journey from when you get the offer, because you're getting an indicative offer. So you've got to go through a whole due diligence process after that. So, given my background in investment banking, it was, I knew what that was like and how to run it. And so I was probably in a much better position to do that than most other founders would. But it's, look, there's excitement when you get an attractive offer. I mean, it's sort of non-binding, and then it's a bit of an exhausting process as you work through the sort of diligence over sort of 2 months. So, I think you sort of, in some ways, there's excitement at the start, and then there's relief when you get to the end of it, actually sign it. So I would like to say that you jump up and down when you finally signed it. I think you probably feel tired and exhausted, and there's a sigh that, oh, thank God that's done. But no, it's good. I mean, then I think once it's signed, then you've got a period to completion. But I mean, we had a very short period of sort of 4 weeks between signing and completion. So there wasn't really any risk that it was or wasn't going to happen. So that was sort of pretty quick.
Cool.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Should we chat about go-to-market strategy?
Yes, 100%.
Between 0 and 10 customers?
Yeah. How did you acquire your first 10 customers?
Well, I mean, it's fortunate because Lincoln Easton, who sort of had the idea and sort of generally sort of started it and put probably more of the blood, sweat and tears in the early days, just because he was well connected in the construction industry, and this was a real pain point for not just where he worked, but a lot of other construction companies. So I think we're quite fortunate that maybe not 10 customers, but there was certainly a handful of customers that were, because of those relationships, were happy to sort of work with us and trial a sort of beta version. So that sort of helped give a bit of we sort of probably have 5 or 6 customers agree that they were going to look to use it. So that sort of helped us get up and running with the first customers to sort of test the system and work out that there is something here.
Mm-hmm.
So I mean that maybe we didn't get to 1 million, but sort of get into the hundreds of thousands, and from there then we've got to start to have a sales team, and I think the next stage sort of very focused on direct sales and rubber on the road, like going out and meeting customers, talking to them, selling it. Not many people have heard of you at that point. So it's sort of a hard graft of really, direct selling in those early days. I think as you start to progress, and I think probably once you start getting to 5 to 10 plus, you start to build out the sales team. You hire more salespeople. You do realize that like there's a limit to how much you can continue to expand sort of direct sales. I think once we sort of got to 5, we've sort of split it a bit more, become a bit more sophisticated. You have sort of SDRs and account executives, and you're splitting functions, but also starting to look at partnerships and indirect channels to try and leverage it. So, I mean, probably in that 1 to 10, we had a number of sort of integration partnerships that are important, given we were doing the claim and payment process. I mean, the most important part is for us to integrate were the financial ERP systems. So, I mean, in the US, like, depends on geography, which are the bigger ones, but Viewpoint and Sage in the US, or Coins would be the biggest one in the UK, and probably JobPack and SheOps in Australia. So they're getting those integrations, and when I call them partnerships, I mean most of them there wasn't necessarily any revenue share there, but getting those integrations was quite important to try and sort of, I think, leverage that business sort of beyond that 10 million in ARR. And then we sort of looked at key people in the ecosystem, who was most relevant to partner with. We did have a number of partnerships in place where they were sort of providing lead referrals to us, and we weren't just reliant on a sort of direct outreach in terms of a direct sales model. It was a combination of direct. It was probably 2/3 direct, 1/3 indirect.
Mm-hmm. So in direct sales, you mean this would be like people would physically go into construction sites, calling people, going to trade shows, so on and so forth in the earlier days?
Yeah, that's right. So be your sales team, whether it was SDRs doing calls to arrange meetings. Trade shows, particularly in the US, trade shows are big.
Massive,
so they
yeah.
were, a critical sort of lead generation source. So much more in the US trade shows than other geographies.
Was it sorry, mine just in what so the note when did what I'm trying to understand this question is when you moved from just Australia, which is where you obviously started, to the global stage. Like, at what sort of revenue did that global expansion happen?
Look, we moved pretty quickly to I think in hindsight, probably quicker than what we should have. We would have been probably about 4 or 5 million by the time we went to the UK, and probably not a lot more. Well, certainly less than 10 before we went to the US. So, I think in hindsight, when you look back, you sort of get excited with initial interest. We probably needed to do more work on product nuances and product market fit. I think we were a little bit naive in thinking we could take our product to the UK or US and largely sell it. It's it's taken a lot of work. I think we thought like the UK we could go and sell it. I think there was probably in the end like multi-years of work, and in the US we had interest as well. I think one of the great things about Payapps is it was very easy to use and it was very intuitive, so people really liked it. It demoed well. There were some key product gaps in the US. There's some things that, like lien waivers in the US, that we don't see elsewhere. That was a big part of the claim and payment process in the US. So we were, I've worked with another company more recently to help them around US market entry, and certainly learn lessons that we need to do a lot more work before you go in terms of understanding the market, the product market fit, the competitive landscape. So we got into the US probably, we were well short in terms of where we needed to be from a product perspective. There was Textura, which was really probably the only player in that market, but had done a great job of sort of establishing the market and had a lot of the large construction companies in the US. So there was another smaller company that was only sort of less than 2 million in revenue, but had a really good product, GC Pay. It was an underinvested business. We acquired that. A bit of luck, a bit of good management. Circumstance came up with sort of ill health of the major shareholder, and we were able to acquire that in late 2018. So we actually ended up using that as our platform. So while Payapps is in multiple markets, we actually had a separate platform for the US.
That's interesting.
And I think it's funny.
Go on.
You talk to sort of investors or acquirers, and I think if you don't really understand all of the detail, you sort of think, well, gee, why would you have two platforms? That's inefficient. If I invest or I buy it, I'm going to move it all to one platform. I think when you really get into the detail and understand, there's also not a lot of crossover from a customer point of view, which I think makes it easier to have two platforms. If you had lots of construction companies that were in the US and UK or Australia, there'd be much greater emphasis perhaps to have one platform. But it is such a big job, I think, to try and bring them together. I think people that I would respect that actually really understand the nuance and detail in the payment application process would understand that while at a superficial level you should have one platform. And look, if I was starting Payapps again, yes, could we build a single platform we could. No one's successfully achieved that anywhere. So it does show it is really, really difficult. So look, I think that worked well for us. I think it's the facts and circumstances of that it probably was nuanced to what we were doing. I wouldn't say that should be the base case for businesses going forward, but it just became difficult once we could leverage that, and to try and build one platform was going to be a massive job, let alone the data migration issues that sort of follow on after you've done that. So there just wasn't really the upside of committing the amount of resource required to that versus focusing our attention on continuing to improve the product.
Was it difficult to convince investors that having two platforms is the right way? And how do you get around it? How do you get around convincing people who not necessarily know like why? Because
I think you got to be a little bit respectful and tell them that, explain that it's like there's complexities and it's difficult. I mean, it can be done. I'm not saying it can't be done. So I'm not sitting there saying you'd be stupid to think you can do that, because you've just got to say, look, there are quite significant differences. It is a big loss. It's a big lift. It's a question of priorities. Do you want to allocate a lot of your product and engineering resources to build one platform, or do you want to continue to improve the product offering you've got? So I think where you've got a pretty long roadmap of feature enhancements that you want to get done, are you really prepared to put that on hold to try and allocate resources to build a single platform? So I think in talking to people, I was never sort of overly negative in saying that it can't be done. I mean, it can be done. I think it's just a question of priorities, and saying, well, something we could certainly look at is, you don't want to underestimate the product nuances that exist between the two. So, look, ultimately, Autodesk is the acquirer. That will be up to them as to what they do going forward. But if I was making the decisions and running the business, I'd be keeping them separate.
Very good.
Geoff, we've heard a few times about the startups in construction built in Australia that they have to get out because of the TAM. Do you agree? And what's the right time for them to start thinking about getting out to different markets?
I mean, I do agree. If you want to build a meaningful company, while there's a lot of great things about Australia, the reality is it's a very small country. So it's been very fertile ground for construction software. You see, Aconex, Payapps. There's a range of others as well that are doing really well in different niche segments of the market. But so, I mean, one of the advantage of Australia is that, I mean, one, there are other success stories in construction software, but it is quite a developed market. So, you've got sophisticated construction companies. They adopt technology. You can build good technology here and look to take that to certainly the other more developed markets like the UK and US. So, you're going to be, I think you are going to be too limited if you just try and continue to stay, because the TAM is quite restrictive. So, I mean, I think sort of by the time you get to sort of 10 million of ARR, most of the construction software companies would be looking to other markets. I mean, perhaps they don't go to both the UK and US. They might start with one or the other. But I mean, there are one or two that have gone well past 10 million without meaningful expansion offshore. But it does, it's just we're just limited by size. So I think we've seen most of even the up and coming construction software companies certainly go to at least the UK.
I wanted to just touch on the growth. What was the growth curve like in Payapps? Was it like a straight line, or has it been fairly flat and then more exponential growth? And what was the inflection point for this growth, if there was some like exponential hockey stick at some point?
Yeah, I mean, look, we did. I mean, we hadn't really raised any institutional money, and I mean, you'd probably call what we did in 2020 maybe it's probably bigger than a normal Series A, but you'd probably call that a Series A because that was our first preferred deal. Before that, we'd raised money a number of times, but more from high net worth, and we didn't have any single large investors come in. So I think in terms of growth, we had underinvested in growth until 2020. I think that's probably one thing I look back and say, look, we probably could have moved more quickly. I think when I look back and say, well, 2015 was really our first year we had anything to sell. It was probably pretty tough through 15, 16, 17 just to get critical mass, start to get a bit more of a network effect happening in certainly Australia where people had used it. So, look, I mean, we did have pretty consistent growth, certainly from 18 onwards. We were probably through 18, 19, 20, 21, probably in that sort of 50 to 70% growth, and probably fell back at 23. We were probably more like sort of in the 40s. But look, we definitely we really built out that US presence. So I mean, our US business sort of got to sort of circa half of the revenue of the business. So that was probably the growth engine that was sort of, and I think all markets were, UK was the smallest, so that was off a lower base. But look, I mean, even in Australia, sort of growth was still sort of, even towards the end, it's sort of 30% or more. So we did have wasn't a hockey stick. I mean, it was pretty steady in that sort of 50 to 60% year on year.
Nice.
It's never as easy as you think.
Do you see founders in the construction tech space?
Software? I
Get
think
wrong.
it's
maybe what some of your lessons and advice
it's hard
you
if
can share.
I mean, it sometimes that what I would say is try and hire some good people in the verticals, whether it be sales, customer success, product, engineering. Ultimately getting good people where you can, because I do see a number of businesses, not just in construction, where you've got a really good founder. A lot of the sales are dependent on that founder, and they can do quite well in that sort of 1 to almost 10 million of revenue. I think once you're trying to go that 10 to 50 million of revenue, you've got to start building the business out. You've got to bring good people in. And as I said, I think just if you're looking at going to a new jurisdiction, make sure you do plenty of work, a couple of trips, make sure you understand. I think, I mean, we were guilty of it, but we're not the only ones, is that you make a commitment to go to a market and you find out your product market fit's not as good as you think it should, what it needs to be. And if you've got 12 or 18 months of engineering and product work to be done to get it to product market fit and you've already committed to the market, that's not a good thing. So I think putting in a bit more time and effort to really scope out the market. You're never going to cover everything because the more people start using it, you start finding out more things. And look, 10 years in, we're still getting feature requests in different markets. So it is never ending almost in terms of feature development, but yeah, just making sure you don't sort of get over your head too early, and you've got to find a point where you sort of start to bring other people in and delegate sufficiently so you can actually create a scalable business. Look, I wish I could tell you 100% of the time we got it right or there was a fail-safe way of doing it. I
How do
think
you make sure you employ the good people?
Yeah, well, I think some of the lessons are that, look, it's tough in a startup scale up. So I think you need to be confident that those people have got
what are the lessons?
Yeah, have got the ambition and desire. Like, you want people who are self-motivated. I think one of the I would always be looking at going for people that have worked in that environment. I think I've found it a bit harder to bring people from much larger organizations in where they have a much more established sort of infrastructure set up in terms of the way it operates. They've probably got bigger teams. Ultimately, the hardest thing is probably getting from to get to 10 million. And I think to get to 10 million, you really need people who have done it, can roll up their sleeves, and not overly precious, good communication skills. Look, I think you get better at making those selections. There's no way of getting it right every single time, but yeah, there are a few qualities you've got to sort of look for, I think, in terms of that desire to be, part of that ecosystem. Also, I think you're going to have better success if you've had a referral or someone you know and trust has worked with them. So, look, that can't always be the case, and some very good people have come from other sources, but probably the success rate is slightly higher where you've got sort of, trusted referees and feedback on roles. Given my banking background, I think the biggest mistake I see
Geoff,
time
can you
and
show
time
your
again
views on
founders
capitalizing
make
businesses?
if I just
I'm
go
guessing
for
you're a good
another
person
3
to ask with
months
your
or 6
background
months,
too.
I can get revenue to here.
Yeah.
I think the biggest mistake people make is cutting it too fine, not giving themselves enough runway for the business actually to execute. So, my advice continually is sort of raise before you need to raise. And ideally, if you've got the option, raise a bit more than you think you actually need, because when you actually look at the extra dilution in totality, sometimes there is a little bit, but in the context of putting the business on a really solid footing and giving it the best chance of success, as I say, you'd rather a slightly smaller piece of a bigger pie than a large slice of a smaller one. So I see that all the time. Founders just too slow to raise capital. I think they underestimate how much time it can take to raise that capital, and it is also very distracting, to the business. It does take a lot of time and effort. So that's why sometimes taking a bit more, you might say there's an extra few percent dilution, but ultimately give you more runway. It'd be longer before you need to come back, and that enables you to focus on the business. So that would be the one I see, so often people just just taking too long to appreciate that now's the time to start fundraising, and don't sweat it at the margin. Just make sure you get it done, you get the money in, and you can execute on your business, because that's what's going to deliver value.
This is a very difficult question to answer, Geoff. But how about dilution? Like, do you have like a false generally
Look, I
about
don't
like
think there's a
at what
rule of
stage you
thumb. I
should
mean,
be
it
diluting by X
does
amount? I know there's a
depend.
lot
I
of like
mean,
other
each
factors which come into
business
play, but
is a bit
are there
different
sort
in
of
terms of sort of,
some guide rails that people could
capital
perhaps
needs.
learn or understand?
Look, I ultimately think if we raised more money earlier, we would have been worth more at the end point. So I actually think I could have taken a bit more dilution earlier and actually had a higher share price at exit in hindsight. It's hard. I mean, because I came from investment banking, I mean, you go back 7 or 8 years, the whole concept of, I was probably a bit more focused on businesses actually need to make money. And that's right. You definitely need to make money, but the power of SaaS software companies is you just adding to the as long as you've got minimal churn, you really just, adding to your revenue base each year. So you can quite quickly change the margin profile if you've got really good growth. But look, I think beyond getting past your sort of seed, when you get to your first raise, most people are probably looking at sort of 15 to 20% of the capital being issued. But I mean, I don't think there's any. It really is a case by case. I mean, you're not going to go out there and issue 50% of the value of your company in a single capital raise. I think you just need to balance it against the sort of capital requirements of the business, how hard you want to go on growth. It's a balancing act. I think you can't let your cash burn get too far out of control, because I think just you risk if things take longer and you haven't addressed that, by the time you get to your next capital raise, it can be pretty painful if you haven't significantly narrowed that gap. So I always found there's always that trade-off between sort of top line growth and not necessarily profitability if you're not at that point, but just feeling like you can manage that cash burn such that you've got, a line of sight within a sort of 12 or 18 month period back to break even is sort of, if the business continues to grow well, you say, well, I'll continue to invest, but how long would it actually take me to get back to break even if I needed to? That's the key question. And that's what you've got to balance.
I like what you said, that the ultimate concept of a business is to make money.
You can create a lot of value,
but the key question is at what
money,
point?
but you do have to balance it. I mean, you've clearly got to be able to. I mean, ultimately, it's about how strong the unit economics you've got are. If you've got really strong unit economics, you can afford not to be profitable. There is a point clearly where you do need to get past that crossover, and you need to be able to demonstrate margin. And I've certainly seen in my that. I mean, definitely sort of since we've moved into probably the last 3 years, it's interesting in some, not really with growth equity, but certainly in terms of exit to strategics, there's been a growing focus on margin. There's no doubt about that. Yeah, I mean, I think what I'm talking about there is sort of is really sort of gross margin. If
Hmm.
you've got
Can you elaborate a
a
little bit
very high
about
gross
strong
margin,
unit
you
economics? Maybe can you give an example?
you can move your margin profile quite quickly once you start to scale, because a lot of your other costs are not going to move linear with how your business grows. So I think if you've got if your sort of cost of acquisition and payback is really strong, you'll find as you scale, you'll be able to quickly reduce your cash burn or increase your margin once you've sort of gone through that break-even point.
That's a finance lesson ahead of us, Owen.
Yeah. I'm not gonna lie. I'm not gonna pretend this is my strong subject that we're going on to now. So
Yeah, look, it never ceases.
I might
I
just do
mean,
some
you
homework
sort
after
of
this.
think that
Jeff, how about your
it's a pretty
holistic view
well
nowadays on the
developed sort of
construction tech scene?
construction
Like, what
tech
excites you?
space.
What
I
you
always
perhaps
get
skeptical
surprised
about as well?
by there are new point solutions that do come up. I mean, some of which do sort of incredibly well. So you would I mean, I often think by now you'd think that sort of every piece of the end to end in terms of software and construction would have been pretty well covered, and I think to some extent that they are generally covered. You just find sometimes point solutions come in and do it at an increased level of sort of they just do it better, or they do it at a more detailed level that sort of adds value. I think. I mean, and this is crossed. I mean, look, AI is clearly, while it is a buzzword, it is going to be a real enabler, just not across construction. It's whether it's in your business and allowing product and development people to be more efficient. Certainly, a couple of other businesses I'm involved in, people are probably seeing that you've got product and engineering teams because of AI that perhaps twice as efficient. They can do either twice as much, or you don't need as many people. And even just seeing some interesting things, around even the sales and marketing processes and how AI can sort of improve that as well. So, and then there's huge amounts of data that's held. I mean, you look at the data that Payapps has, let alone the bigger project management systems that are out there, the Autodesk, Procore, Oracles, and I mean, there's probably some issues to work through in some cases in sort of ownership of that data, but there's a huge amount of. I mean, we never really we talked about it, but never got around to really progressing it meaningfully. But I think with the AI capabilities that are even there now, let alone what's going to be available over the next year or two, that just the data insights that can come from AI, pouring over those sort of that huge amount of data that sits there, I think can really improve the efficiency of construction. That's a tough.
Jeff,
I mean,
we'll be wrapping up,
clearly
but
the
last
biggest
question for
area
me
is,
would be
I
if
mean,
you were
project
to build
management's
in the
where that
construction
sort of
space
is probably
again,
the biggest piece,
which
because
area would you go into?
That's fundamental to the whole sort of building or construction process. So it's a difficult one. It's probably a much harder area to break into, given you've got some very large established players. It's really, it's hard to move too far from what you know. I mean, I'm probably a little bit given what we did a little bit more on the finance side of things in terms of sort of claims. I still think there's a lot more, particularly in the US, that can be done around payments. I'd probably be focusing a bit more around product on. Yeah, I mean, you know it so well. So you mean not that I will, because not just because I'm restricted from doing it, but I think even in our space, there probably still is room for one or two independents to emerge. But I'm not seeing that at the moment. The other area I quite like is, I mean, health and safety. It's I think there's still a way to go there as you look at what we see in Australia in terms of some of the uplifting requirements around that, probably at a higher level than what is in the US today. I think there are already a number of players. The bigger players do have some form of solutions, but I still think there's a lot of opportunity there. I mean, Hammertech's one in Australia and the US that's done quite well. I think there are a couple of other players coming up in that space as well. So I still think there's plenty of opportunity there.
Mm.
Nice.
Okay.
Geoff, just zooming out, and with perhaps you can draw on some experience from your finance background, but do you seek any kind of shift within the construction industry? Obviously, globally, the world is changing. I mean, it always is, but like in more recent times, I suppose, it's become a little bit more volatile. So, what do you think that? That will change how construction operates? Will there be different ways of financing
I mean, I think they are.
the
I mean, is
industry?
it
Like,
going
will
to
for
change?
example, maybe I can give you an example. Is like
as
private
I said,
equity seems to be
I
getting more
think
interested in the
AI
space,
is going to have a big
which we have
impact
heard
on
through various
improving
whispers. So,
efficiency of
yeah, broad
construction. I
question.
mean, that will
Hoping you
take
can take
a few
it as you
years
could.
to play out. I think. I mean, the thematic in software, the bigger players are going to get bigger. You look at Autodesk, which is incredibly strong position in design. They've built out over the last decade construction. So you've got all the bigger players, whether it be Autodesk, Trimble, Procore, Oracle, they're all getting bigger and trying to expand their. So it's interesting as a construction company, you've got greater reliance on fewer providers as a lot of the point solutions get acquired, which is, I mean, good and bad. It's nice to have everything in one place, but you do become more beholden to those companies. Yeah, yeah. So there's a balance there. I mean, people don't want to use 20 systems, but then if they go all the way to using one or two systems, they're
to their pricing models.
they're going to be sort of in a more difficult position on renewals and price negotiations.
Mm-hmm. Cool. All right, Geoff. Well, thank you so much for joining
Look,
us.
if people are interested, you
Hope you
can
enjoyed it.
reach out to me
Is
on
there
LinkedIn.
any? I mean, you're
Yeah,
obviously
I
not
mean,
building necessarily the
I've got a
minute,
real
but if there's
passion
any
for
initiatives you've
software,
got, if not, you
so
can
I'm
just
going to
tell
be
people
heavily
where they can find out
involved
more about you.
I'm definitely going to be involved in new software companies and opportunities going forward, but I couldn't tell you today what they're all going to be, other than I've got a passion to do more. So, people will, if people want to reach out and follow me or send an invitation, sort of happy to connect. And yeah, so I mean, I'm not looking in the immediate future to go back into sort of any CEO role, but probably having 2 or 3 things that I'm meaningfully involved in, perhaps without having the day-to-day responsibility of running it. But and we'll see how that progresses. I mean, I really enjoyed the journey on Payapps. Not ruling out doing another one. It's just you just got to find the right opportunity at the right time. So, all right, it's been a pleasure.
Yeah, that's what we want to hear. Sure. All right, Geoff.
Thank you so much.